Welcome to this update for the Ftse 250, and I'll also be taking a look at the macro situation in the UK. But before I start, please remember I'm doing these videos just for fun as a hobby. As you can see with all the satire here, always speak to a qualified financial advisor before making any investment decision. Now, to start with, I like to look at the long-term history that's got us where we are today. And for many decades, the world governments and central banks were following a classic Keynesian economics model where you would get these classic boom and bust cycles like the dot-com bubble and then the credit crisis, but where interest rate was really the only main tool that they were using. Following the credit crisis, however, we entered the era of new Keynesian economics, where quantitative easing or massive money printing was used in conjunction with interest rates. And this led to a massive increase in the rate at which the stock markets went up. However, at the same time, debasing the currency to quite an extent. This was only really possible because there were these pervasive deflationary forces, particularly globalization and the growth of the internet and technology. Following all the government mistakes of the year 2020, the governments responded to that actually by even more money printing. And so we've had ever since 2020 NKE plus. However, the surge of money printing led to really bad inflation. And as you can see here, interest rates have now gone up again to a level not been seen for a couple of decades. So the performance of the Ftse 250 has been really bad actually in the last few years. And if you were to account for inflation, we'd actually be down here somewhere. And as I'll be going into, the macro is definitely showing you what you'd expect in that regard. Technically, we've broken out of this trading pattern, but I'm very suspicious of this. Pound sterling, this is a pound sterling US dollar chart, actually strengthened by 12% against the US dollar since the beginning of this year. So this does make me very suspicious of this breakout here. So looking at the macro headline numbers, and we have a negative GDP growth according to the latest data available, high inflation, and unemployment is low, but it's actually creeping towards not being low anymore. Stock markets are actually okay, but house prices are stagnating. Looking at the long-term historical data here, we see that interest rates, although higher than during the new Keynesian economics period, they're not historically that high. Inflation is on the high side and GDP growth is looking really bad. In terms of unemployment, we're actually historically at a low number, but as you can see, the trend is not looking good. And then in terms of the inflation, there is a problem with this number here. I didn't want to change how I calculate things just because of one number. But what's happened is that in April we had a insanely high month-on-month inflation print, and that one number, this was because Ofcom increased everyone's energy bills, but that one-off increase has then totally thrown out my data plot because I like to put them together into quarterly packets to then derive my estimate from. However, even if we were to assume that this number was only 0.3%, that would still give us a number down here where you see this blue circle. So regardless of if we did cook the books or not, inflation is still rather high at the moment. And in terms of government debt and fiscal deficit, they're very high and perhaps stable, but perhaps looking quite uncomfortable. So when I look at the Ftse 250 and accounting for the strengthening of the pound sterling against the US dollar by 10%, what we see with the macro kind of does make sense when we look at how the stocks have been struggling and are still at a value lower than they were in 2019. And so I am very uncertain what the movement's going to be next from here. And so I think extreme caution is required. We have to remember as well that although the UK and the rest of the world are still going ahead with the new KE plus model, which is a kind of globalist model. The US is embarking on economic nationalism, a completely different economic model. I go into that in great detail in last week's video I did on the US macro situation, but this could affect things in all kinds of different ways. We wonder if the Trump tariffs could slow down things all around the world, which would be a deflationary force. So the fact that we are retaining normal relations with China, whereas only the US is imposing these tariffs, that could actually lead to an increase of inventory, which would actually be a deflationary force. So my headline statement there would be that the uncertainty awaits, but my headline message would be that the macro is looking very bad and the geopolitics is also very uncertain at the moment. The new Keynesian economics plus model only works because the pound sterling is relatively strong against a lot of other currencies in the world. It's 5% of the world's reserve currencies. So we always have to keep a sharp eye on pound sterling because the collapse of that would send the entire system breaking down. Well, as I've already mentioned, pound sterling's actually been doing very well against the US dollar. And in terms of the yield curve, it's a normalizing yield curve. Of course, we expect maybe a couple more drops, but it is actually turning into a historically normal curve. It's just that we've left the era of cheap money. People are going to have to pay high interest rates to borrow money. See the developing trend here quite clearly. The purple line is a year ago, and look at where we are now versus a year ago. In terms of all the businesses out there competing with each other, the easy days are over. And this high interest rate environment is certainly going to sort out the wheat from the chaff. So here I've got my dashboard data for those who like that. If you'd like your own copy, you can find it on my Twitter account. I post this data there. Here's my Twitter handle. It's also in the description of this video. But zooming into the latest data, and it was very interesting that Andrew Bailey actually reduced interest rates only just the last few days. It was kind of a controversial rate drop, and I'm not sure there'll be too many more of them, as I'll come into in a moment. In terms of quantitative easing, we're actually quite a bit above the target where we're meant to be. I think they did actually stall it for a month or something because of some drama that was going on in the world economy earlier this year. But they have otherwise kept it going, but it is a little bit above target. Overall, in grey here, you can see where the quantitative easing is compared with where it has been. I could actually see them halting QT for a bit in the next few months. They actually decide that officially in September because this is something that's addressed on a yearly basis every September. The year-on-year inflation number was high at 3.6%. Now, I don't like this kind of crappy year-on-year numbers, so that's why I like to use monthly numbers. For a better data set, I then package that into quarterly packets for my own real-time inflation estimate that I do. However, regardless of if you use the year-on-year, the monthly, which would have been over 3%, or the quarterly, regardless of which way you measure it, inflation is quite high at the moment. House prices have had a bit of a shocker the last couple of months. Now, it's important to kind of put that into context. So, when you look at the longer term data, it's not that bad. But yet another bad number taken in from a different angle here. And in terms of real gross domestic product, we had another negative print for May. Unemployment was low, but it is starting to nudge up towards what would be considered bad numbers. So we got it with my executive summary, and when you peer in here with a bit more resolution, we see it even more. the UK seems to be in a bit of a stagflationary situation. And so the crappy performance of the FTSE 250 over the last 5 years kind of makes perfect sense within that context. And of course, you need to speak to your financial advisor, but my thoughts are that my thoughts in terms of investing are this is why you need to invest into different things, not just equities. There are other asset classes out there. And if you are investing in equities, you've just got to be very careful which particular sectors you pick. So that completes the main summary of this video. I will now though go into some of the data that I record on an ongoing basis for those people who like an update on that. We can see perhaps a slight improvement in terms of the overall government debt and fiscal deficit situation, at least until the second quarter fiscal deficit number that's just come out, where it looks like a nightmare. In terms of government debt as a proportion of GDP, there is ever such a slight widening of the gap there now, but it's still a sustained, kind of sustainable but unpleasant trend. And the government continues to spend more money than they take in taxes. Socialist government spending as a percentage of GDP, i.e., money being controlled by the state and not by the individual, sees us at this unpleasantly high number still. The current number is 44% of GDP. And so this gradual march towards communism continues. In terms of retail sales, they're kind of down the last couple of months, to be honest. This is sales volume as well. They're lower than they were back in 2022. So although things look like they were on the upswing, they're kind of looking subdued again. Here we have long-term interest rates. So from where we are now, interest rates are kind of historically low now. They're not historically high, they're actually historically low. Same unemployment is low historically as well. And inflation, though, is on the high side. And this is very interesting. With inflation at about 3% plus, it really is on the high side. And house prices are interested when looked at in this longer term chart. If the price was to keep dropping until November this year, and there was this massive house price panic, it would be interesting to then invest in home builder stocks if you thought that this trend would be maintained. In terms of GDP, it kind of continues to trudge along, but a lot less impressively than with the US data. And in terms of M4 money supply, we have this interesting kind of exponential curve still being maintained, as is the case with the US and the rest of the world. And finally, in terms of public sector debt, this is where we are now versus World War II. And in terms of fiscal indiscipline, we're still quite an unpleasant number here. So that completes my look at the FTSE 250 and the UK macro situation. I hope you found this useful and see you at the next video. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.